policy loan. Once you've got your policy all set up, you funded it, maybe threw in $50,000, $100,000, and you want to take the policy loan so you can go throw that money into a syndication deal or go and spend it however you like. You just, for a lot of times, you can either just call up the insurance company, call Tyler, or some of you guys don't want to talk to people. A lot of times you can just go on the internet portal and make that direct deposit right to your bank account.
Yeah, and so what internally is happening is, and it can vary from company to company. Some companies, you'll see a decrease in your cash value. Other companies, your cash value stays the same. What's happening truly in the policy is nothing really being taken out of your policy itself. It's more that your death benefit is collateralized. So the insurance companies are able to give you a policy without any additional underwriting because they already did the underwriting. They know that you have this death benefit. They will only give you so much. And then at some point, we all will die and the loan will be made whole on the death benefit if we don't pay it. So that's really what's happening with the loan. There's no terms set for the loan. That's where you're in complete control. You should be practicing you should have good financial discipline of paying the interest, the servicing, not causing it to implode in that sense by just continually pulling out the loan and letting the interest grow.
But it's extremely hard to have it implode or cannibalize itself. I mean, that you guys are think of it like a HELOC, guys. Right? Like in some cases on the HELOCs, your bank wants you to make annual or monthly payments back to make sure you're still alive. And same thing here with the insurance companies. And a lot of this is just mindset. Some investors, they get really nervous when they have to pay back their HELOC, or in this case, their loans, their cash value. But remember, you're paying it back to yourself in a way and at very low rates. And if you're smart, you finagle this as a business expense. And therefore, you can also, if you're smart, you can get a deduction for it too. So if you're borrowing something 6% or 5%, if you're deducting those interest costs, really you're effectively borrowing at, say, 4%. And that's the key to this whole thing, right? Because we're making money tax-free at 5%. That is actually tax-free. So you could argue that it's 6%, but you're borrowing the same amount of money through your cash value at maybe 5% worst case, but then it's deductible. So it's really like 4%. So you take the delta 6 minus 4% in this crude example, and that's the spread. And that's the little loophole here, guys. It's nothing game changing, but the kind of the point is like, this is a nice little trick to augment your returns just a little.
And yeah, there matters what company you're using. Some of them provide fixed loan interest rates. Some of them are variable. Some people are wary about the variable, but again, almost all insurance companies, the variable loan interest rate is based off the Moody AAA corporate bond index, and that historically has been very low, I think in the 2%. But companies also have a floor on how low their loan interest rates will be. So in most cases, they're at that floor. They've been at that floor for a while, probably will remain there for a while going forward. Some loans get treated, people may hear direct versus non-direct recognition. Direct means that the company is recognizing that the loan is taken out, and they'll treat the funds on that loan differently. Could be less or could be more, could be better or advantageous to taking a loan. So you'll see a decrease in the returns. For non-direct recognition, it really looks invisible to the company that whether you have that money out or not, they'll treat those funds the same way. It'll just receive the same dividends like it never was taken out. There's some chatter that one is better than the other. It really matters the term. So for Guardian, it's a non-direct recognition. But what happens with the funds that are loaned, they actually receive a better dividend rate, a slightly boosted dividend rate. So in this case, if you were to compare the policies side by side, if one was to not take a loan out and one was to take a loan out, at the end of the day, yes, you have to pay debt servicing, but the cash value in the loaned policy will be actually higher because of the slightly boosted up dividends. Some of this is changing, some of the rates with the 7702 products coming out. So you're seeing slightly lower interest rates, slightly lower floors, which is overall better for the consumer in that sense.
Yeah, and I'll be honest, guys, for my policies that I have, I don't know how mines are in terms of direct versus non-direct, which I mean, to me, it is what it is. That's not the, I don't know. I think you got two people on the call, right? People who like to like know every little thing and they ultimately never do anything. And those are unfortunately the people who finally got into alternative asset investing in their 40s and 50s too late. We can definitely get you as where you want in a decade. The people that jump on this quick, that kind of just, they understand the big things. They just drive down the commissions. So I'm paying for at least amount of that as possible. And then they get moving. They jump into a $10,000, $50,000 policy in the first year and they fund that for several years. And then you start to learn about more of these nuances, right? You know, that's just my personal advice, is just get moving with one of these things. Most of the family office clients that have already set this stuff up, they'll say a lot of this doesn't really matter. I mean, we just like to educate people. Maybe we educate people too much where it freezes a lot of people. And that's what people I advise at this point, you know, kind of self-recognize who you are.
Yeah, and we put this in just because this is a lot of getting a lot of attention also just in this low interest rate environment. A lot of the insurance companies, their floor policy loan interest rates are higher. It's like some of them are at 6%, some of them are at 5%. And people are asking, well, why I can go out to a bank and get 3%, 3.5%, and create a better arbitrage there, or better spread. There is the opportunity. There's banks out there that you'll basically collateralize your cash value or your policy cash value, and the banks will be giving out loans at, you know, three. I think some people are seeing like 3.25% or 3%. There usually is some limit on a minimum of cash value you need in order to be able to do this. And I've heard historically it's been 100,000. I think they may be lowering that in some banks, but this is another option. Just be aware though, you are giving up some of your control of your policy at that point. The bank has some control of it. A lot of times you're going to have to ask for permission to do certain things with your policy from there on forward. But it is an option out there. Personally, I value the control more than the interest rate, but this is something out there that people are.
Yeah, I think I'm on the same side as you. I think it's just too much of a headache to save 1.5% to do this. I'm not too concerned with the control aspect, but nothing's easier than just going to your life insurance website, putting in direct deposit and just sliding $250,000 into your bank in a few days. It's there to go through the extra step. But these are some of the advanced, we'll get this into the advanced topic. We've got like a list of different third-party banks that will lend on these policies if you really want to maximize stuff. And a 1.5% on several $100,000 policy, that's serious money right there. That's more than what most people make per month. It might make sense. And that's, I think, when you start to build a relationship with Tyler, those are the things, the relationship goes on even after you make your policy. Because those are the kind of the things that's what we do to stay on the forefront of this stuff. So you guys are optimizing the usage of this stuff. But you got to set it up first, and best day to do it was yesterday.
Yeah, and one more aspect of the collateralized loan is that you're probably have a set payment plan or some bank terms that you have to pay back. So, you know, that's also part. It's not only the control, sometimes it's also the flexibility, and that's you're giving up some of that.
Yeah, and even in our mastermind group, where a lot of the guys are more fiscally advanced, you'll get hung up with the mindset of, oh, now I have to make another payment. If I take money out of my 401k, I have to pay taxes on it. Yeah, just set aside more money. Because at the end of the day, it's like, how is your net worth growing? That's the whole point. How soon can you take out a policy loan? Maybe a couple weeks. It's pretty much, we say it's instant, but there is some administrative moving around time. So if you're trying to go into a deal in the next couple of weeks, maybe plan ahead. Yes. But once this stuff is all set up, you should be able to get the money back out in maybe a couple days, as I've seen personally.
Yeah. So there's two parts, I think, to this question is, once you make a premium payment or a deposit, I like to say, you have 10 days. So the cash value will grow basically probably to the second day after you make that deposit. You'll see in your portal your cash value increase. It also even say available loan increase. But to be safe, we usually wait 10 days after that deposit in order to take out that loan. Because from a lot of the insurance companies, the funds don't truly clear until that 10-day mark. You're able to take out a loan, but the insurance companies will require a lot more documentation because they're worried that people are laundering money or it's fraud. So a lot of times you need to show on your bank account statement, the actual statement, not a screenshot, that the money cleared your bank, which usually is, you can't do that within 10 days. So I'll just say 10 days after the deposit is when the funds are available. And then how fast it shows up could be 2 to 3 business days. To tell people is that when you go on the online portal, you request a loan, and the second business day, especially if it's ACH, it'll be in your account. If it's a check, which you can also request a check, it's just slower. I would say it's 5 business days or so, the check in your mailbox. So it's not instant, but it's pretty quick in that sense. Same thing with your payments. It takes 1 business day actually to probably show up in your account. So it's liquid and almost just like doing online banking.
Yeah, so the practical setup is maybe you have $25,000 in your checking account. You always want to have very little money liquidity in those types of no yield balances. But then a deal comes up, you want to throw in 100 grand, you take a loan from your cash value, it shows up in your bank account in a couple days, then you complete your PPM docs, you wire off your funds. And then shoot, there's another awesome deal that comes up. You want to double down, you want to put 200 grand. No, you take the same cash value loan. And this is where I'm saying you got to fund it enough to get that magical number you want to look for, that amount of dry powder. For most people here, anywhere from like, I would say a couple $100,000 to $1 million of dry powder that you want to have just sitting here ready to go. And also there for emergency savings too. There are some FAQs here for you guys too to check out later. But let's talk about this. So we talked about, so you got your policy, you're taking a loan from it, and this idea of cannibalizing or decaying on me, right? You take a loan and in the background, there's like a payment plan happening. Now your policy may not be requesting payments back every month or every year, but it'll slowly be eating away at your cash value. Tyler, if you can explain this, how this kind of works. And it's not that big of a deal, but it's important to understand like how the policy kind of preserves itself.
Start out. So when you do take out a loan, a lot of you're paying upfront the interest, or you're not paying, but they're calculating the interest upfront. So if you take out a $10,000 loan and say the interest rate was 5.5%, that $550 will show up as interest due on your policy, but it'll be prorated to your next policy anniversary date. So it's not really due until your next policy anniversary date. Any payments you make back to your loan or to the interest, it'll truly just reduce your principal, which then also gives you some credit on that pre-calculated interest rate that's due. If you don't pay that interest on your policy, on your next policy anniversary date, that interest then will actually get added to your principal and it'll have that compounding effect. But within that policy year, it's really being calculated by simple interest. And for me personally, that's the key, keeping the loan interest simple interest while your policy is growing at a compound interest. At some point, if you don't make any payments, the interest will continue to grow, and it has a potential of exceeding your cash value growth. And that's where it'll start borrowing from the cash value, start going negative, and at some point it could implode. Is that what you were asking?
Yeah, so when people are like setting up their policy, they realize like I need to set up a commitment amount in a way. And I think a lot of people here, we set commitments and we say what we're going to do, and we get freaked out because I don't want to put in 100 grand per year if I can't hit it, even though I have $800,000 in the bank and equity in my house that I could get at, that I have to pay in the next 6-7 years. People might be a little timid signing up for a larger amount, which is actually what they probably should be doing, like $100,000, $200,000 per year. And one of the things is if I don't hit if I say I'm going to do 100 grand per year, but year 3, I have a bad year in my business, what happens is my policy collapses. The life insurance take back my policy, which is not the case, is what's going on.
But to go back to the specific question, in this case, I think they're asking if they can't make the premium payments years 2 through 6 or after the first year. And so to me, the flexibility and the beauty of the 1090 split is that because the premium is only 10% of what your target amount is. If you max fund it year 1, you're really buying ahead 10 years worth of premium payments that's due. So year 2 or 3 or 4, if you're not able to make even that premium payment, even this $100, it'll take the cash value, but you've prepaid a lot of that. By prepaying, you also are starting to earn dividends and interest on that. But that's where it's covering your downside. So you're able to, the policy won't cannibalize quickly because you've overfunded it, especially in the beginning. And then even at some point, year 8, you're able to, you could do a reduced paid up at that point, and you're not going to lose the money per se. You're still going to be breaking even at some point. And we can, when we look at your design, we can stress test it and say, hey, what if I paid the full premium at year 1 and then nothing from years 3 to 6? What does the policy look like? And most times,
Worst case scenario.
yeah. And a lot of times you're still breaking even probably at year 5. Of course, the cash value is way lower than what it would be if you've max funded it, but it's not, the policy just doesn't go away. We're able to preserve it and design it for that flexibility.
And this is where I didn't really grasp this until you told me a few months ago, this idea. I always just thought the boogeyman was going to come and get me and my policies were going to collapse on me and not making my annual commitment amount was not an option. What Tyler just said in a different way, right? If you made your full, say you sign up for 100 grand a year, just use a nice round number. The premiums on that is just a mere 10% of that. So if you're funding it for 6 years, $600,000, $60,000, 10% of that is your base. You've already made that. If you funded your first year 100 grand, like you probably will be, because I know you guys are going to want to fund this as quick as possible, as heavy, especially in the beginning. You've already funded that 60 grand plus already. So you're good. You don't have to worry. It's not going to cannibalize, collapse on you, and then the life insurance is going to take everything. It's not the case. You've already hit them.
And that's why, that's the benefit of the 1090. Now, even a 30-70 split, then the numbers get a little bit, your downside is it's not as flexible, but you just got to run that math. So if it's $300 and $700, you front loaded it, you bought yourself 3.5 years of premium versus the 10 years of premium. It's just math.
Yeah. So again, look, guys, this is a little confusing, but once you grasp this idea, I think you guys will feel a lot more comfortable. And actually, nowadays, I'm actually even more cavalier. I'm looking to fund this thing over $250 per year, or at least set the policy so I can set the policy up here so I can hit it if I have a good year. Deals cash out. That's where I want to put my money. I don't want the money to sit in my bank account making nothing. I want a container for this stuff to go into. So that's why I'm even more cavalier about the idea of making that ceiling even higher, even though if you don't fund it the first year. Because so in this case, say you said you were going to do 100 grand every year for 6 years, so a total combined sum of $600,000. I would say the most people who say they do infinite banking from yourself will do like a 70-30 split, like how Tyler is saying. So 30% of it is going to your base premium. So 30% of $600,000 is 180. In this case, I would need to fund pretty much 2 full years so I don't lose the policy value. If in case something happens and I can't put any more money after the second year. Still, even at a 70-30 split, which is not as advantageous, and how I think that's the secret sauce, guys. That's what kind of separates us. 2 years out of the 6, that's still pretty dang good. I think that should make people pretty comfortable. But if you do an 80-20 split, like how I personally have, because I like the ability to pay up to increase it even more after the high originally set up for 5 to 7 years. But it's pretty easy to hit, especially if you've already paid your first year. If you already paid your first year full way, you're already there.
Yeah, and we're not saying that we encourage you not to max fund it every year. It's more just covering your downside, covering the what ifs. But it is most advantageous to max fund it every year as much as possible.
Yeah, and this is again comes down to Tyler's situation, and sees enough of these cases and start to make you aware of different ins and outs of things that you should be aware of, or situations that, other places to go get money from to kind of stuff and maximize the policy to get it even bigger. So you have a bigger cash base to invest out of.